Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most? And do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
Okay, welcome to The Wealth Flow. My guest today is Chris Picciurro. Chris is a CPA. He is an author now as well, an educator, and really teaches people about, and a tax strategist, and teaches people about taxes. He's been on the show a couple times now, and so we are thrilled to have him back. And so, Chris, welcome to The Wealth Flow.
It is an honor to be back here, and I really enjoy your show. I love what you're doing in real estate, and it's an honor. I don't take these opportunities for granted. And if you haven't heard, there's been a massive paradigm shift in our tax law that was signed into law on Independence Day last year, July 4th.
Yeah.
So we're here to talk about some of those changes, how they're going to affect the common or taxpayer that is and then all the way into someone that's investing in real estate. So yeah, I'm excited about talking through those things. In general, the bill is pro taxpayer, pro real estate investor, and now the question is how do we legally and ethically utilize those opportunities to reduce our tax?
Yeah, exactly. I can't wait to dive into this because it's always, that's one thing about your job that I think is really neat. I mean, there's things that are always changing, and then it's just about how to take those changes and strategize and use them to your advantage as you're planning your taxes. Before we dive into that, though, for the audience, I just would love to kind of start with your background, where you grew up, what eventually led you to being a CPA and kind of getting into this world of taxes.
Well, thanks for asking. I grew up in Mount Clemens, Michigan, ended up becoming Clinton Township, Michigan, which is about 8 to 10 miles north of Detroit. If anyone's seen the movie 8 Mile, that's the border of Detroit and many other cities that border it, east side, east suburb, and learned, I've always been entrepreneurial. My parents are very hardworking, very blue collar neighborhood and family, but even from a young age, when I was in late middle school, early high school, became a paper boy. So for those of you that don't know what that means that before the internet, we actually read what was going on in the world on a piece of paper. I still love it. If I don't have the paper anymore, but when I go to a hotel, there's something about opening that newspaper and kind of having your breakfast. So a paper boy would take their bike around. I would have to deliver newspapers to people's houses because at that point, the only way you would know if the Detroit Tigers won, other than watching the news, because we didn't have cable, we didn't have all this stuff, and then cable came into play, but would be read the paper, look at the box scores. And guess what? If you wanted to know what was on TV, meaning you had a TV guide, you needed the newspaper. If you wanted coupons before apps, you needed the newspaper. So probably 80% of people, at least in our community, subscribe to either the Detroit News or Detroit Free Press. The Detroit Free Press came out super early AM. Detroit News was afternoon. So when I'd get home from school, I would have the responsibility of loading up my bike. And yeah, half the year was snowing out, loading up my bike and delivering the papers. But and it was a very prestigious job to be a Detroit newspaper boy. Like, it was hard to get, and I was very fortunate to have that opportunity. However, it was my first stab at entrepreneurship, because what a lot of people didn't realize is that, yes, I was a 13, 14-year-old kid. I had my own business. I had to pay the Detroit News wholesale for those papers. I had to collect the money from the subscribers. I had a ledger. I wish I would have kept some of them, where I had to go to their house. And guess what? Now if someone knocks on our door, we're like, oh gosh, no, we're not going to answer our door, right? We got a Ring doorbell.
Right.
I would have to go door to door, knock on doors, and collect the money for their subscriptions. I still remember it was $1.65 a week, $3.30 every other week. And I had to know, did this person pay monthly? And by the way, when I was that young, and this is, again, let's be fair, 38 years ago, I'm 51 years old now. If someone paid monthly, I'm like, wow, they've got a lot of money. That's like $6.80 or whatever for the month. But here's the cool thing. I had to keep track of my own ledgers. I had to keep track of my accounts receivable. If I had stuffers, meaning, let's say there were extra ads on the paper, I got a penny each one that I inserted in the paper and delivered. And but I also learned how to meet people where they are. What do I mean by that? Well, I was growing up in a very blue collar area, and I knew to go collect money on Fridays. Everyone got paid on Friday. We didn't have direct deposit. Like, people actually had cash. So I'd go collect Friday, hoping that they'd give me $2 and say, keep the change. However, we had a few customers, I should say. Now I say, Keith, I've been doing the CPA stuff so long, I call them clients, customers that had that were retired. And a lot of people from where I grew up, especially in the Detroit area in general, a lot of ethnicities kind of stuck together. So I grew up in a very Sicilian, Italian neighborhood. So I knew, and three of my four grandparents were Sicilian. I knew the retired Italian Americans had dinner at their house every Sunday night. That's just what they did. So for those clients, I went on Sunday afternoon before they had dinner, when they had a couple glasses of wine, and they're going to be a little looser when they open the door and this little paper boy's trying to collect money. So I kind of started learning entrepreneurship then. When I got to high school and my academics got a little harder and I was playing some sports, I had to give up the route. But that was my first stab at being an entrepreneur. So going in, I wanted to be entrepreneurial. Luckily, in my high school, they offered an advanced placement, or AP. They offered accounting course. You could take it your junior year or senior year. I took it my junior year. I liked it. Our instructor was a friend of mine's dad, actually, who would come to the school early in the morning. He was the CFO of a lumber company and just kind of wanted to give back.
Yeah.
So I took it, and it was more like a college course because we only met 3 days a week. And then I did pretty well on that. And then he invited like 20 of the kids to take AP accounting our senior year, and I took AP accounting. And so ultimately, I was leaving high school, and I graduated, to be very clear, in 1993, and from high school with already 2 years of accounting experience. At that point, you couldn't take an AP accounting exam and get college credits. But so I walked into college, and I thought, okay, I love accounting, I love finance. If I just get my CPA license, I could do anything. And that's kind of the route I went. So, So then went to, and I'm graduating from Michigan State. So I'm a big Spartan fan. And then our dog's name's Sparty. And then went to, so just started entering the workforce, working at a CPA firm. I worked as auditor for Ford Motor Company. And luckily, back in those days, they paid for my master's, and I just kind of set myself up pretty well. But by my mid-20s, I just was like, man, I don't know that I want to stick with this larger CPA firm and try to make partner route. I think I'm going to just go off on my own. And when I was 27, I bought a modest condo outside of Detroit. I bought a car. I said, I'm not going to get financed for a few years because I had a really stable job. I'm going to leave my job, start my own CPA firm, my own practice. And that was August 2002. So we're talking 24 years ago now.
Wow.
And just, so I think that being good with numbers, enjoying helping people out, and feeling like that's honestly is a gift from God that I enjoy helping people out, that I enjoy educating people. And it hasn't been an easy road, right? As anyone who's been a business owner, there are, especially for over 20 years, there are times where you're doubting, not doubting yourself, but doubting some of your decisions. You've failed forward. You've probably put your payroll on a credit card at some point, right? If you have team
Right.
members, we've all been through that. We've lost a client for some reason that you can't even explain, or it's a windy road, but if you're the kind of person that believes in yourself and is willing to bet on yourself, it's a very rewarding road. And I've been very fortunate to partner with amazing people in this career and be a part of a great team now, and try to, and if we tie this into to taxes, try to take over 20 years of experience and give it to people as far as stories and helping people. And then I realized about 10 years into the practice that tax preparation is important, but what we're missing is tax planning and strategy. We're missing all the stuff looking forward, and they're not competing. They complement each other. And it's just tough. And now we're in this environment where we have, aside from AI, which could be a great tool for our profession, we have in our profession a retirement cliff. So according to the AI in American Institute of CPAs, 75% of CPAs are going to be retired in the next 15 years. And we have what's called a pipeline issue. We have a third less people even sitting for the CPA exam. So it sounds like, oh man, you're on the great side of the supply and demand curve. Yeah, we are. However, we need some more tax planning and strategy. We need some more education. I mean, think about this, Keith. You could become a CPA and not learn nothing on the CPA exam is about tax planning. It's about tax compliance. There's no tax planning and strategy section. So we're training our people the rules, but we're not, and we say legally and ethically, but there's reasons you want to use the rules to, like you said, to your advantage.
Yeah.
And that's what we have a passion about. And that's why we created our our teaching tax flow community, which is what I can see the first tax planning and strategy community. Now, I know we have other communities and like a Bigger Pockets or Rich Dad, Poor Dad, specifically for real estate, but for anyone. And I truly believe, and I appreciate you mentioning that I'm out there, truly believe that lower to moderate income households benefit the most from tax planning and strategy. Maybe not dollar-wise, but for a single parent, that if we could free up $150 a month of disposable income, that could be 50% of their disposable income for the month.
Yeah.
So now, as a CPA, yes, our private CPA practice that I work in and one-on-one with our clients, yes, those people are typically going to be very sophisticated, real estate investors, entrepreneurs, or very high income, high W-2 wage earners. But I still feel passionate about of helping out these other folks that haven't been exposed to tax planning. So, and unfortunately, we talk about a lot of the myths of tax planning. A lot of people think having your tax return prepared is tax planning. And it's just not. They're completely different. So think about anything looking forward is tax planning and strategy. Anything looking back is tax compliance or tax preparation. So long answer to your question of how I got here. But it's really, it's been a lot of blessings and a lot of working with a lot of great people. And also, coming from a very hardworking family and understanding that I'm willing to take some risks. I think my parents were probably shaking their heads when I started my practice, thinking, okay, you just went through and college and you have a great job, everything that the Rich Dad, Poor Dad book teaches. I was the poor dad, but it was like oh
Yeah.
man, this looks great on paper. And I'm like, well, even if I start the CPA practice and I fell flat on my face, I can get another job. So
Yeah. Yeah. No, that's great. That's great. And your community does such a great job of really kind of getting the word out there. So, I think that's tremendous, and I love the way you describe kind of the entrepreneurship as being a windy road. I've heard a similar explanation of that, and it couldn't be further. Couldn't be more true. It really is. It is a windy road, and
yes.
it's not always a pleasant road. Sometimes you come across some bad weather, and but you work your way through it, and I think it ultimately makes you stronger and more well-rounded. So
Yes. I just heard something this week, and I've been thinking about, we've probably seen that image of the iceberg and how it looks pretty on top of the water. But
Yeah.
someone was talking about entrepreneurship. I know who one of our strategic partners, actually, that we were meeting within our teaching tax law community said, think about a duck. A duck on top of the water is beautiful, but under the water, they're scrapping like heck to stay afloat. You don't see
That's right.
their little legs, those skinny little legs, keeping this duck up on the water. And as an entrepreneur, like you understand, we're doing a lot of that under the water that they're making it look, trying to make it look easy because
Yeah.
you want to give your clients and your community confidence that you're going to be there for them. So,
Absolutely.
yeah.
Well, let's dive into it, Chris. As you mentioned, there's been some big changes with the big, beautiful bill passing, and a lot of things that people may not be aware of that change. So, why don't you kind of describe what some of those big changes were, and we can just walk through how that affects just the average taxpayer, and then also we can obviously get into the real estate side of things as well.
Absolutely. One of the things, so as you listen to this, or as I even did my hair today, so if you're on the YouTube channel, you could see it. But as you watch this or listen to this, I want you to take a step back before we start thinking about your tax return. I want you to understand that one of the we created the 3 laws of tax planning in the teaching tax flow community. One of them is that tax agencies are your involuntary business partner. And that means that tax laws are written to encourage and discourage certain behavior. That behavior could be social, it could be environmental, it could be financial. So as we think about this, let's think about, we have 2 sides of the aisle, basically. There's people in the middle, but 2 sides of the aisle in DC. Both of them have to compromise. Both of them have to agree. Both of them want votes. So when we think about, okay, what tax rules that are new out there that you could take advantage of that represent, as you say, for the masses, larger voting communities. So there are 4 new temporary tax deductions available here for the 2025 tax filing year. And by the way, if you're driving around, walking your dog, maybe you're out for a run or something, and you feel like you missed one of these, take a breath. You have 3 years to amend your return, right? You could go back and
Yeah.
we were just talking to someone, I literally this week, that I found they might not have gotten the best advice, and we found a couple of deductions that they were entitled to that they didn't take, and they're going to get $2,000 back on an amended return. So if you listen to this and you feel like you missed something, I'm going to tell you how to look for it, and you're going to be all right. But so there's 4 new temporary deductions starting for 2025. They're going to be available for the 25 filings, 6, 7, and 28. Interesting that it's a 4-year deduction, right? Well,
Yeah.
so that's that. And again, when we think about that we're going to talk through the IRS being your business partner, but Keith and I are lucky that we're in these no tax states. Me being in, I shouldn't mention this, even though I did grow up just outside Detroit. My family and I have been in just outside Nashville and Franklin, Tennessee for the last 10 years. So I got rid of that state tax, but local and state taxes are also your business partner too. So any tax is your business partner. And the other thing to remember is that as we talk about these new deductions, is that tax brackets, lie to you. Meaning, because there are phase outs and cliffs, you really want to figure out what your marginal tax rate is. So these deductions could be more valuable than you think. So they are as follows. One, no tax on tips, right? So if you are in a customarily tipped industry and you receive what are called voluntary tips, then those might be a deduction off of your tax return. The key is voluntary, right? So when you go to that restaurant and they jam you up with a 20% or 18% service charge, is that voluntary? No. So I've seen a lot of restaurants now change it. I don't know if you've seen it, Keith, where you're going and it's like suggested 18%. It's not just putting it on the bill, or suggested 20%. That's actually there to protect their employees, to make that a voluntary tip so that it's not involuntary. But anyway, so no tax on tips. Now, one thing something to remember on this is that there are income phase outs, right? So just because you get tip income doesn't necessarily mean that it's a deduction. But the vast majority of people that are tipped are going to be able to take that off their tax return. Also, no tax on overtime. Okay, it might say no tax on overtime, but there are phase outs. So if you earned overtime, gosh, so who are we hitting right now? Service industry people, do they vote? Yeah. Do people in the Rust Belt, do the Pennsylvanias, the Michigans, the Ohios, that Rust Belt, blue collar, heavy overtime, or those people during the holidays in the retail space that are working overtime, does it hit them? Absolutely.
Yeah.
So no tax on overtime. This is an interesting one. No tax on new car loan interest, up to $10,000 of vehicle loan interest if it was a new vehicle. Who does this? I think the big three are happy. I think the Nissan, I think the dealerships are happy. I think the banks are happy that loan on vehicles, right? What are we trying to do? We're trying to encourage people to buy new vehicles. Vehicle has to be final assembled in the United States. So as I mentioned, these rules, we don't have first of all, we want to keep you engaged and we want to give you as much information as possible. We could do a whole episode, and on our podcast, we break down a full episode just on every one of these deductions, but there's no tax. And then the fourth one, now remember during the election of 24, both parties were banting about like, hey, let's have no tax on Social Security. It doesn't work that way. That's a whole different fund. So as a compromise, the new, I call it the mature age person deduction, but the new senior deduction came into play. That's $6,000 max deduction for anyone 65 or older at the end of the year, $12,000 of married joint. So those 4 new deductions are now available. You will report those deductions on a new form called a Schedule 1A, and that just gets attached to your personal return. There are phase outs, and if you're married filing separately, you don't get some of those deductions. The point is, we are seeing a lot more refunds this year because the withholding tables didn't know this was even going to exist. So if you are getting overtime pay, this is something that a lot of people get confused about. Hey, I've got overtime. People think overtime's taxed more than regular time. It's not. The withholding's higher, but it's still taxed at whatever your marginal tax rate is. So we're seeing a lot of people with overtime and tip income getting larger deductions. So I've been thinking about too, because I've been very fortunate to do some teaching peer-to-peer, and I was like, how can I come up with a case where someone gets all 4 of these deductions? I was thinking about it. So I was thinking, okay, well, I came up with something. Let's pretend someone is works as a Santa Claus during the holidays, and their spouse is kind of sick of them sitting around the house all day. They tried to play pickleball like me, but they got injured because they're 70 years old or 68. So they go and they start getting tips for something. Like they get tipped because they're Santa Claus. So, and they work overtime because the holiday hours are high. And they're over 65, so they're getting those 3 deductions. And then what happens is they feel like they deserve a new car and they bought a new car before the end of the year and they get to deduct the interest. I don't know. But that would be my only way. I was trying to think of how someone could get all 4 of those. But in all seriousness, we estimate between 25 and 30 million taxpayers will be affected by one of these deductions. So definitely, if this applies to you, take a look at and by the way, the tip deduction isn't just for employees. I want you to think about all of our gig economists, Uber drivers. Got shoe shiners and kind of like people, valet drivers. Like there's a lot of applications to this that it could be ignored. So definitely, if you think you qualify for one of those, take a look at your tax return, see if you filed a Schedule 1A, and if not, talk to your tax professional or leave a comment on this YouTube video and I'll answer it for you.
Wealthflow audience, pardon me for a quick interruption to today's show, but I have some exciting news that I want to be sure that all of our listeners are aware of. We just launched 3 totally unique to the market funds that are at the cutting edge of technology and AI. We have combined my 25 years of real estate experience and my recent work as VP of development for a tech company to bring 3 awesome investment options to our audience. For full details, go to our website at bobocapitalventures.com. Again, that is BOBO capitalventures.com. All right, back to the show.
Yeah. No, that's great. It's one that a lot of people, like you say, may not have taken full advantage of. And, just, I guess, looking for the Schedule 1A will kind of let you know whether you did or did not take advantage. And as you pointed out, you still have time to amend that return. So that's
absolutely good. You could amend for 3 years. And Keith, something to think about is if you live in a state that has a state income tax, some states are complying with it. Some states are partially complying with it. Some states don't comply with it. Just to make in income phase out. So are play a role too. So if you're right on that threshold of getting the deduction or not, for some people, it might make sense to put money into like maybe a traditional IRA, or maybe you're getting the full deduction and you don't need, and then the Roth makes sense. So these are where we take a talk in our community all the time. Ideas are cheap, implementation is valuable. So this is where those implementations of, should I be doing this? Should I be doing that? Really like figure out, does it pertain to you? And is it something you want to implement? So absolutely.
Yeah. Okay. Fantastic. Well, what are some other changes that have taken place, or things that people just need to be aware of?
Right. So I'm going to mention one change that was very helpful. The salt tax deduction. Salt is, some people put salt on their eggs, on their French fries. I don't know. I'm not against it. But the SALT stands for state and local income tax. So for those taxpayers that itemize their deduction, so as a taxpayer, depending on your filing status, you get what's called a standard deduction. That means that's the amount of income you can earn without paying any federal tax. If you itemize your deductions and those itemized deductions exceed your standard, then you're entitled to the itemized deductions. Well, part of your itemized deductions would be SALT, state and local income tax. That limit for married joint was only $10,000 previously. That was part of that Tax Cuts and Jobs Act. And that was kind of a jab at the high tax states, to be quite honest, right? Your Californias, your Florida, not Florida, New York, New Jersey, all the usual suspects. Well, part of the compromise of the OB3, that's what I call One Big Beautiful Bill Act, is that, hey, let's take the SALT tax deduction and raise it up to $40,000 max for married couples. Again, there's phase outs based on income. That means if your income exceeds a certain amount, we're talking hundreds of thousands of dollars, you get phased out of that deduction and you might go back down to the $10,000. But that increase in SALT is huge because I think it's going to increase refunds and it's going to allow more people to itemize their deductions. And now if they're itemizing their deductions, then any type of tithes or any types of charitable contributions are deductible. And part of the state and local income tax is going to be your property taxes, your state income taxes, and your sales tax. So like in Texas, Keith, we were kind of talking before the show, you could be in Texas, even though you still have no state income tax, you could my wife has family in Texas, so I guess I have family in Texas too then. You could be easily paying $18,000 in property tax. You were limited to $10,000. And what if you bought a new vehicle? Well, you could deduct the sales tax from that new vehicle. So you could have $25,000 of state and local income tax and be in a no tax state. And now you can itemize instead of taking the standard deduction. So the SALT tax deduction increase is something that's going to be pretty effective and for many of the people in those states. So that got raised. And there's some other things. So I got an example, Keith. We were kind of talking about our families. I'm going to have 3 teenagers in the house in a couple weeks. And if you've had teenagers, if let's say you've had a child that went away to college and they come back. Let's say before they went away to college, they had a curfew of 11 at night. And they go to college, and we know, unless church choir practice is at midnight, we know that they're in bed by 11, right? And all of a sudden, they're out late. And now they might be doing fun stuff. They might be just playing cards or, I'm not suggesting bad stuff. But when they come back for Thanksgiving, and you try to go to them and say, you know what, you have a curfew now of 11 again, that's hard to pull off, right? Or it'd be even harder if you said to your child, you know what, you're 15 years old, your curfew is 10, your bedtime's 10, you're 16 now, and actually we're going to reduce it to 9. That's not going to go well, right? So why am I talking about bedtimes on a tax podcast? Before the One Big Beautiful Bill Act passed, all these larger standard deductions and a lot of these other things that were passed by the Tax Cuts and Jobs Act, including estate tax, were going to go away. We weren't even going to realize it. So part of what the One Big Beautiful Bill Act did for a lot of people is preserve the things we already had, like the higher standard deduction, like the qualified business income deduction. And some of these other things, the estate tax exemption got preserved and now is $15 million for 2026. So a lot of these things that were kind of thrown out there like, hey, we're going to take them away, got preserved. So that's very pro-taxpayer. And I would say for people that, on the estate tax side of things, not only is the estate tax now $15 million, meaning you could pass away and the beneficiaries of your assets, unless the assets over $15 million, pay no estate tax. Now, they might pay income tax if, let's say, the money is in a retirement account or anything like that, pre-tax account. But that's very generous. And the other thing that a lot of people forget is, let's say you have a married filing joint couple and one passes away. The other one now can continue to use a DSU. Oh gosh, another acronym. Deceased Spousal Unused Exemption. Meaning, let's say you have, we've got a bunch of things that's going on in our private practice. Let's say you have a married couple and they have $4 million worth of assets. They each have $2 million. The first spouse passes away. Well, if the estate tax exemption is $15 million, that means they could have had $13 million of assets tax-free. The surviving spouse can now make an election and say, I'm going to grab that $13 million and I'm going to permanently put it into my estate. Now, do we think that spouse will ever have $28 million of assets? No. But what happens if the estate tax goes down to $2 million, which it very well could in 4, 5, 6 years from now? But they've locked in that unused estate tax exemption. So these are just things we have to think about. Yeah. Again, for things that happen most people aren't even aware of, but those are things to think about, especially if you have appreciated assets. And if you're listening, you could in certain areas you might not have $2 million worth of cash, but you might have that mature age person, they're getting the senior deduction, that lives in a Hawaii or a California that their house is worth $2.5 million. They've owned it for 50 years, right? And now they can pass it on their beneficiaries tax-free, which is good.
Yeah, that's great.
And I do want to point out one more thing, and then jump into real estate investors, but thinking about that. So I was talking about the Schedule 1A and those new deductions. I want you guys, people listening, to think about the planning opportunities now. Let's say you have and we've been doing a lot of this. Let's say you have a married filing joint couple. Let's say they're eligible for the $6,000 senior deduction, but each of them. That's $12,000 worth of deduction. If over the next 4 years, they can convert $48,000, so almost $50,000 out of their traditional IRAs into Roth IRAs tax-free if they utilize that deduction properly. So that's where the planning comes in. And instead of that pre-tax money being subject to, required minimum distributions in the future and that sort of stuff. So there's always planning opportunities with these rules.
Yeah, for sure. Which is, again, why you want to work with somebody who is a tax strategist who has the ability to look at these things, at an ongoing basis, and you're not trying to play catch up. Because quite honestly, if you don't find out about some of these things until you're doing your taxes, it may be too late on some of them to properly prepare for them. So,
absolutely.
Well, I was just going to say, well, why don't we jump into, some of the changes, but also the things that can affect a lot of our audience
Yes.
that are real estate investors, things that have changed, things that have maybe come back, all of that good stuff.
Right. So real estate investors, you were given a lot of helmet stickers, right? I don't know if you watch college football, a lot of those teams put those little stickers on their helmet. I don't know if those Texas Tech Red Raiders do that or not. I can't remember. Which you may or may not be a fan of that team. But so fully preserved 1031 exchange and in 100% tax deferral. During the election of 2024, there was some chatter about, okay, well, 1031 exchange should be should be $1 million max, whatever. It doesn't really matter. At this point, the 1031 exchange is fully preserved, which means that you can sell real estate, investment real estate, do a like-kind exchange, and ultimately, if you want, never pay tax on that gain for your entire life and preserve what's called step up in cost basis to your beneficiary. So if they sell it, a day or 2 days, hopefully they wait more than a day, soon after you pass away, they're not going to, it's reportable, they're not going to owe any tax on it. How many asset classes does that exist for? That's it. You can only do 1031 exchanges now for real estate. Back in the day, you could do it for any. And the beautiful thing, Keith, like we've talked about, is the 1031 exchange means like kind doesn't mean I'm selling commercial building and I have to buy a commercial building. You can sell an investment in land, farmland, mobile home park, any type of real estate, and parlay that into another real estate investment and still be qualified for a 1031 exchange. Now, can you do it by yourself? No. We need to use a qualified intermediary. You need to work with professionals. But you could even go from something like we've got a client in our private CPA firm practice right now that's selling 2 commercial buildings for about $2.2 million. They have no debt on them. They've owned them for probably 30 years. They're almost fully depreciated, but they're sick of the day-to-day maintenance. Let's just say they are qualifying for the senior deduction at this point, and they just want to place their assets, park their $2.2 million into something where they're getting mailbox money, and now their kids are going to inherit this tax-free. And so it doesn't have, so my point is you could be in a real estate activity where you're very active in it and go more towards a passive activity or what we call mailbox money. So 1031 exchange is still in play. So that's pretty nice. Something that's going to be huge in 2027, I'm mentioning it now because with the proper planning, you can take advantage of this. With the Tax Cuts and Jobs Act, there was something called a Qualified Opportunity Zone investment. And we now call that the QOZOG, the first iteration of Qualified Opportunity Zone funds. All of those Qualified Opportunity Zone fund investments are now taxable in 2026. But starting in 2027, there's going to be a new set of Qualified Opportunity Zone opportunities. I know that's redundant. We're calling it QOZ 2.0. And what the listeners and watchers are going to want to know is that you could take any capital gain and invest it into a Qualified Opportunity Zone fund and defer that capital gain for 5 years at any time. And the nice thing that this does is that if you either have a failed 1031 exchange or let's say you've got, let's say you purchased a rental property, in Galveston, Beach Place for $800,000. It's now worth, $1.5 million, and you sell it. and let's say you have a $900,000 gain because of depreciation. You now don't, if you didn't want to do the 1031 exchange, you could just take your gain and put it in the qualified opportunity zone fund. You don't have to do a full 1031 exchange. You could take a portion of your gain. You could take a gain from NVIDIA stock or cryptocurrency or digital assets and put it in a qualified opportunity zone fund. So you could take gains from selling a business there are some related party rules, and put it in a QOZ. So any capital gain in general can go into a qualified opportunity zone fund, and you can stretch that and kick that, defer the tax for at least 5 years, and there's some other benefits to that. That's pretty cool. That starts in 2027. So why am I talking about this in 2026? What if you have someone that's thinking about selling a property and they want to maybe just hold on to it until 27? Or here's another thought. I've got a property, we've been working with a client, I've got a property, or I'm selling my business, or I got an asset. Keith, I'm going to sell it to you today. You're going to give me a little bit of a down payment, but we're going to have a balloon payment due in 2027. We're going to do an installment sale so that I'm moving that capital gain into 27 for me. And, it's got to be the right buyer and seller, but those are some of the planning ideas that we have. So this new opportunity zone fund is going to be a boom for real estate investors and syndicators, and also a way for people to defer those gains. So I think that's going to be, we're going to start hearing about that a lot more.
Yeah. No, it's amazing that ability to have a capital gain, and like you said, it pretty much. I mean, there's just such a wide variety that you can now put it into opportunity zone. When are they going to have the kind of designations of which properties that will affect? Do you know what kind of that looks like on the horizon?
Right. Yeah, we're expecting it. I believe it's this July. I believe it's this summer. When the Tax Cuts and Jobs Act came out, what happened was it was a mad scramble, right? Because that was at the end of September. They're trying to figure this out, and the federal government basically went to the governors and said, "Hey, governors, you go identify the real estate tracts that are going to be qualified opportunity zone funds." This is now that was 2018. Well, here's what happened. And I bet you saw this in San Antonio. The governors didn't know what to do, but they knew they had to find places that had lower home ownership percentage and lower per capita income. What did they do? They went back to the 2010 census. So there were spots in many cities that were already getting gentrified or already turning around, that were identified as opportunity zone funds that were actually nice areas. And now they might be nicer areas than you think. So there's a whole map that'll be put out for those funds. And then you're going to have, now remember, just buying a piece of property in an opportunity zone fund doesn't make you a qualified opportunity zone fund. There's a process for creating a fund, or you invest in someone else's fund to get the tax deferral. But we're expecting this summer. They're also going to identify, because what happened is the vast majority of the qualified opportunity or the opportunity zones were in urban areas. So there's going to be a special farmland zone that gets even a better tax benefit than the normal qualified opportunity zone fund. So the summer of 2026 is when those will be identified. Yeah. It's going to be interesting. Very interesting. Yes. And then, to kind of put a bow on some of these things with real estate investors, we've heard it already that bonus depreciation, 100% bonus depreciation has been extended, brought back, and actually made permanent. Now, whenever I say made permanent, I say that cringily, as the kids are cringy, just because you could have a new regime in 4 years and they could get rid of it. But at this point, bonus depreciation is made permanent. And that's at 100%. And that's the engine that drives cost segregation studies for real estate owners. So that's going to be, that's pretty big. And so, yeah, that's very helpful, for business owners and real estate investors. Absolutely.
Yeah, for sure.
We've got tools, right? We've got real estate investors. You have tools to either kick the can down the road and potentially never pay tax on gains. You've also got tools to accelerate deductions. And you just have to figure out, which ones work for you. And especially with that bonus depreciation, making sure we're pairing those cost segregation studies in tax years that we have a lot of income. And we
Yeah.
also have that qualified opportunity zone fund as well. So lots of things on the horizon. And there are, even with the estate tax being so high, wealth transfer tax, there's some planning opportunities there. And I think that there's, like I said, there's millions and millions more taxpayers that are paying less overall federal tax than before. So we're going to see, we don't know what's going to happen. We don't, I would say my personal opinion is probably the tax that I feel is most likely to get changed would be the estate tax down the road, because, I'm not trying to be crass, but in general, dead people don't vote. And sometimes they do, I guess. And if you're in some states, I don't know but there shouldn't be voting, right? So it's easy to reduce that estate tax and to generate more revenue. But at this point, it's a higher amount, and the bottom line is we're going to look at your just like a football team, or if you're playing cards, you got to look at the hand you have, maximize it, and try to use these rules to benefit you.
Yeah, I think that's a good way of putting it for sure, Chris. Just kind of knowing what potential things within your economic environment you can utilize for what works for you, and plan for. And like you said, I mean, even the ability to restructure a potential offer that you have where you're going to take that balloon payment, in 27 instead of 26, or, whatever it may be, to assure that you can maybe potentially roll that into an opportunity zone fund. So
absolutely, you've got options. And even as homeowners right now, we're going to, mortgage. I mean, you still have the Section 121 or the primary home sale exemption, capital gain exemption available, and mortgage insurance premiums are now deductible, just like mortgage interest. So bottom line is there's a lot out there for you. And take a little time to think about next year's situation and understand that, it's great to have questions when you're working with someone on your tax preparation. A lot of times it's a little late in the game for that, and understand the tax planning strategies is a complementary thing that you can do to complement tax preparation.
Yeah, for sure. Well, Chris, you've got some exciting news. You've got a brand new book out. If you could maybe let the audience know what's the book cover, what if somebody's interested in obviously following you, learning more about you, where they can find all that out as well. But I do want you to give the audience an idea of what's in that book that you just finished.
Just finished it. Thanks, Keith. So if you want to be part of our tax planning and strategy community, we have a bunch of complimentary resources for you. The easiest thing to do is just go to defeatingtaxes.com. When you go to defeatingtaxes.com, you're going to see three things that you could jump on. One is our YouTube channel, which is called Teaching Tax Flow. The second is a link to our private Facebook group, which is called Defeating Taxes, where we answer people's tax questions weekly, and you could even post anonymously. The third is a link to the new book, thanks, Keith, Defeating Taxes, where where I talk about how to think about tax planning and strategy. We have it on, we have a paperback copy, we have a Kindle copy, we also have an Audible copy, which is my favorite. It's less than 4 hours if you listen to it, even at 1.0. I'm from Detroit, so I talk fast, right? But you don't get my hand waving like most people. We talk like that. But yeah, you can check it out. I could promise you're going to get a big ROI from it. It's just going to change your mentality. We have some really good case studies, and I just wrote it for the common taxpayer. And yeah, so I invite anyone listening or watching to be a part of our community. We're happy to help. And selfishly, the community drives our content, what we make videos on, what we're talking about, and that sort of stuff. So, yep, defeatingtaxes.com. And from there, you're going to reduce your tax bill.
Perfect. No, that's great. Chris, this has been awesome as usual. And I have a couple other questions that I ask every guest. One
Yes.
would just be any advice you would give somebody who's maybe just starting out in their investment journey?
Well, I would say first thing is you want to build your board of directors, right? So that's going to be you want to have relationships with your real estate agent, your broker, your mortgage broker, a tax professional, an attorney. That being said, please don't have more entities than properties. A lot of times folks kind of jump in and I bought this, I have one of this LLC in Wyoming that's owned by a C Corp in Wyoming, Delaware that has a Series LLC in Texas. And I'm thinking, that's great. How much? Well, I haven't bought a property yet. I just spent $8,000 on my entity setup. Okay. My point is, you could always set up entities after the fact. A lot of times people don't realize the tax implications and compliance costs. As much as it's good to learn and read and you're going to learn by just doing it. So just jump in, get the first property. Even if you break even or somehow lose a little money, it's going to be way more valuable than the tuition you're going to pay. So you only learn by doing it. So jump in and start small. So for some people, and don't be afraid to pivot. Like, to be transparent, like my wife and I have owned several short-term rental properties. We've enjoyed them, but that's just not the season of life we're in to be running them. And so we're more into buy and hold, or we might do a kind of a slow flip or something like that. So find your spot. Don't be afraid to jump in. And you're going to, take the step to do one property.
Yeah. I think that's great advice. It really is. And I was one of those that did the $9,000 or $10,000 deal. Yeah, and then by the time I did that at the very beginning. I did have a few properties, but it was way too much, way too robust for where I was in my investment deal, and just the maintenance of it every year was super expensive. So it just wasn't worth it. So I shifted gears on that one, but yeah, a lot of people do it.
So I would say, we do. So we did some content on this. Business owners, real estate investors, think about this. Make sure your entity structure matches the risk tolerance and complexity of your portfolio. So if you have one long-term rental, maybe you form an LLC. We got to make sure that you can finance it in the LLC. Maybe, if you're in a market that's a short-term rental, I like protecting it a little more. But you just gotta, or let's say you're investing. I've had people invest in like a mobile home park syndication or any type of syndication, and they're creating two entities to do it. It's like, well, you're a limited partner. Are you really worried that you're going to get sued? But again, I'm not a lawyer. I have to break the news to people sometimes that like you've created all these entities and you have this tax reporting. So
yeah, no, makes sense. How about a book recommendation? Obviously, your book is one, and I'm glad to hear that it's on Audible. I'm a runner, so I'll have to download that one here after our show or our recording. But what's another book? Doesn't have to be tax related. Certainly can be. Just something you've read that's been impactful.
Right. So if as a business owner, I've read a bunch of books that are super impactful. Probably. So the most recent one is called The Science of Scaling. And it really breaks, and it's also, it kind of motivated me to try to keep my book under 4 hours. Because some of these books are like 8-9 hours to listen to on Audible. It just happened to be mine 3 hours and 56 minutes. I didn't try to do it. It was just kind of where I was at word-wise, where I thought it'd be. But The Science of Scaling is a really good book. If you're a business owner, definitely check it out. After you listen to Defeating Taxes, of course.
That's right. All right, Chris. Hey, this has been really good. I always love having you on the show, and always enjoy our conversation. So, Chris, thank you so much for being a guest on The Wealth Flow, and I think we'll call it a show.
I appreciate it. Have an amazing day.
All right. If you're still here, I assume that you found value in today's show and with the guest we interviewed.
please take a minute to subscribe and to review the show. It really helps. Also, wanted to remind you to check out Bobo Capital Ventures to get the first look at our 3 new cutting-edge, first-to-the-market investment opportunities. We have only about 15 spots for each fund for retail investors, and we would love, more than anything else, to have our audience be part of that group of limited partner investors. Thanks for listening to The Wealth Flow, and have a great day.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.